Okay, folks, welcome back. We're looking at the economic calendar for this week. That's the final week of January. Friday is February 1st. So next week should start to see a normalization of market symmetry, I'm hoping. Otherwise, we have to stay in a scalper's realm. And I know that probably doesn't fit some of your specific likes and tastes, but it is what it is. We have to accommodate the marketplace and work within it. It doesn't bend to our will, unfortunately. I've tried a long time, it didn't work. Okay, so we had Draghi speak today at 9 a.m. We had a little bit of lift on euro as a result of that. Tomorrow we have consumer confidence for the dollar at 10 a.m. and we have a tentative Parliament Brexit vote. So there should be some kind of volatility, I'm certain, as a result of that. Common theme going on with the cable lately, pound dollar. Wednesday we have FOMC statement and federal funds rate, and we have the conference at 2:30 p.m. So that's going to be what the market's waiting on. So we'll probably see a quiet, except for British pound tomorrow, we'll probably have a very quiet session. And then post Wednesday we have basically medium impact news, nothing really for GBP until Friday with PMI and average hourly earnings, non-farm payroll again for Friday, February 1st, and then ISM manufacturing PMI at 10 a.m. This week, because of the FOMC on Wednesday and because of non-farm payroll on Friday, this is one of those weeks where you just simply do not want to do anything. You don't want to do anything. And that sounds counterproductive. I know some of you just started, and that's not what you want to hear. But I'm telling you, that's really what you want to hear. You don't want to be in environments where it becomes too likely to create whipsaw, and you don't want to see any kind of action like that. You want to be able to look at where a low resistance liquidity run is going to be, target it, frame it, and then capitalize on it. Looking at the markets right now, and I'm not going to do that today. Today is really just to get you all on board with the same demo account because we have left Forex Ltd in the dust. I'm sick of them having downtime, losing data. It's just really, it doesn't bode well for teaching, obviously, especially if you're paying for an idea or an education through price action. You want to have a little bit more consistent delivery and price. And because it's a demo account, same terms of use apply to it. So there is no, obviously, there's no way for you to make money. There's no way for you to lose money. It's an ideal situation for you to learn in. So with that said, let's go on over to the AvaTrade website. Now, I'm going to say this again. I've already said it before last week on Friday's video, but I do not have live funds with this company. I am not telling you or enticing you or encouraging you or advising you to put money in this brokerage account. I have no affiliation with them. They don't pay me. They probably don't even know who I am. The bottom line is I don't want anyone to misunderstand what I'm doing. Just like I said when I talked about using Forex Ltd initially, I do not want you to put live funds with these people. We're only utilizing their demo account. If you choose to trade with them, you've done so on your own decision. Okay, I'm just telling you that right from Jump Street. We ain't trying to build some kind of a brokerage relationship, nothing like that. It's the way it is. I have to do this for a disclaimer, openly telling you that I'm not an introducing broker, so therefore I don't have a relationship with anyone, and I don't want to have one. Brokers all the time reach out to me. I'm not interested in that. Okay, so you want to go to the demo account link. You want to click on that. Fill in all your information. This email and phone number, I use a bogus one. I never give them my email address, and I never give them my real phone number. And I just do that. With any brokerage account that I've ever used in the past with a demo, I've never given them my personal information, because if you do, they will hound you. Okay, they'll constantly contact, hey, you're going to put some money in here. So again, we don't use that information. Now, I don't know if this expires. If it does, that's fine. You just create another one. It's one of those things that are without end. You just keep creating new ones. You don't want to create one because you blew it out. You want to create one in case it expires. Okay, so once you do all the setups with it, you end up with this. Now, you don't have it set up like this, obviously. You get whatever the default settings are. And I'm going to show you what my default settings are on a chart. This is the British pound. And here's all my properties. That's how it's set. And while I'm thinking of it, I want to set that to black, so the line graph is black. And that's what my default looks like. And then over here, that's what that looks like. Okay, pretty simple, straightforward. Now, when you open up a chart, you want to close all the charts on your platform when you first get it, because there's going to be like default charts opened up. Just close them all out. Have a clean palette, nothing there. And you go up to File, New Chart, and then open up Eurodollar and open up one for British Pound. And then to find the dollar index, you just scroll down in here real slow, and there it is. CFD2, you'll have the dollar index right there. Okay, if you want to do FTSE and DAX, all that stuff, it offers that as well. Really handsome package as far as asset classes and things that you're tracking. For the stock market averages in here, then you have Nikkei, FTSE, you have commodities, which is really nice. To some stocks, more stocks, and then your forex pairs. They group them all in different places. There's your metals, and your exotic crosses that I don't trade. There's oil, and the rest of the pairs here. And what I like about this one is it has the bonds. It has the 5-year, the 10-year, and the 30-year note. And it gives you the Bund and the Japanese bond, which I really don't. If I want to find that, I'll just go up on to Bloomberg. So once you have that, you're going to create, and I'll just show you how to do the bond charts, because that's the one really I just want to do this teaching for that. Now you're going to open up a chart with New Chart, go down to Bonds, and click on 5-year. Okay, and it creates, it'll be probably a larger chart than this. You want to size it to whatever your personal tastes are. And it looks small, probably on your video watching this, but this is actually pretty large from my screen. I have a really big one. So it's small on this single display, but you want to make it small enough so that when you open up a 10-year, do the same thing, and then you want to open up a 30-year. Once you scrunch it down, we'll get rid of Bitcoin, and we'll get rid of the Swissy, and the CAD, and the Euro. And there's our 30-year bond on the bottom, a 10-year note in the middle, and then the 5-year. And all you're going to do is just line it up, make them small enough so you can get 3 stacked on top of each other. And then you want to plot or put the 30-year snug in the corner like this. And then you want to stack the 10-year right over top of all of the border for it, like that. Okay, and then you want to do the same thing with the 5-year over top of the 10-year. And then once you have that, you can see the divergence that occurs that I teach about using the bond market. And you can also pull up S&P, and you can see the relationships of bonds to S&P. So when you go through the lessons for index trading, whether you like to do it or not, or want to do it or aspire to do it, it's beneficial for you to know it. So you paid for it, don't discount it. It's really good information. And if you don't want to trade Forex or stocks, or if you don't want to trade crypto anymore, if you're in here doing that, trading index futures is another potential opportunity for you instead of doing Forex. So with the understanding of the bond market in here, if you see a divergence, as you can see here, lower, lower, higher, by looking at this divergence, you can get a direct relationship of what you would expect to see in the S&P 500 index. It also helps in certain market conditions where you can anticipate moves in the currency market. But there has to be an environment, rather not like it is now, where we have an economic calendar that has a stranglehold on price action. You can see cables just really waiting for tomorrow's parliament vote, or the FOMC stuff that comes out on Monday. This is really holding, not really doing too much. And it's a time of day where you would expect it to be doing this anyway, but it's coiling. Okay, it's tightly wrapping up into a smaller range, and we're expecting some kind of movement tomorrow. So I don't want to do a whole lot of jawboning with it. I was watching it today, and I wanted to see if we could get down here and close up this gap, maybe trade back down into this high right here. And I'll just toss this out because you probably wouldn't look at this as a breaker, but it technically is. We have a low, if you use the wick here, but we have this low here, a higher high, and then lower low. So the run on the stops here, if we trade through this high, market structure is bullish. We could look for a long in here on this high, right here, this last up close candle. If that's the case, right there to the close, there's your range you're going to work within. Now, it's not a demand zone, okay? It's your dealing range. Then you take those two price points and you split it up into what 5 or 0 levels reside within it. Right away, we have 31.38, so we have 31.40, and a low of 31.31, could be 31.30. So we're only talking about 10 pips range there, so you only have 3 choices there. 31.40, which is the easiest one to get to, coming down to it. You have 31.35, midpoint, and then you have 31.30. So you have 3 levels in there. Right away, I'm going to tell you, I'm going to get the easiest one, the closest one to get filled on. That's going to be 31.40. So if price trades down to that, and it does so here, low is 31.37, with the spread, you get it. You can go long there, fill in an inefficiency here, inside this range, and the open on this candle is 31.76. So there's 25 pips in there. Now, that's a tradable bounce using a breaker that you probably wouldn't look for because it's part of a continuation. But that's the power of understanding institutional order flow. It took the stops out here. It broke structure here. Once it rallied through, this is those times where they show in the book, oh, this is classic support and resistance. Yeah, I know. Some of you are not yet, Michael, this is classic support and resistance. Okay, and I get it. I understand that. But you're going to see many times if you've traded, try using support and resistance and see how many times it works for you. When you add the narrative of what is going on from a liquidity standpoint, it makes support and resistance favorable. In other words, it gives you a greater depth or appreciation for what's actually going on versus just saying, well, this is an old low here, so it's going to trade down to that. Why didn't this low get down to it? And why did this high here not stop price here? See, suddenly it changes the dynamic when you play devil's advocate against just the simple or quote-unquote simplicity of support and resistance. When you add narrative to it, understanding what is actually going on inside of this fractal, then suddenly support and resistance will work. Now, granted, it wasn't a barn burner, it wasn't a lot of price action movement, but it was something that could have been practiced on. It could have been, obviously it could be used in hindsight study, and that's what we'll do here. We'll take the rectangle. This is your range, and I really don't like red. So inside this shaded area, we have a defined dealing range. We sold off here, traded down to a breaker, so we could get a bounce. Where's it going to bounce to, Michael? Well, you have a bearish breaker here, and you have a liquidity void. So one of those two could be the catalyst for a profit-taking objective. So if we drop down to a 5-minute chart, you get a little bit more price action in here. We have a low, the lower low, price runs through, and you have several things in here. This is a wonderful opportunity for, even when you're not trading, this is what you do, go back in and you build yourself large sample sizes of these. And this is exactly how I bridged the gap between what I thought I understood from books in the 90s and with real institutional order flow. So we have a sell-off in here. Price fails to get down to the breaker initially here. So we have price crouching right above a point of liquidity. It starts to rally again and dries lower. So what has it done? It took out stops on anyone trying to buy this. I don't know who's buying it. I get that question all the time. Who's buying it? I don't know, but somebody did because they sent price higher. So they entice longs in, then send it lower to the actual breaker. Then we have a short-term swing high in here. Price runs through that. Short-term market structure break to the bullish side. Price comes back down. Where does it go? Just any old random spot? No. The open on this candle, 131.45.5. The low on this candle, 131.446. Off by one tiny little pipette. Itty bitty tiny little variance there. Runs down into it. Obviously, you use the wick down to the open. That's your real sweet spot for order blocks. If you have a wick, you don't want to see it go through the midpoint. That's mean threshold. Nice sensitivity. Rallies through again. Equal highs. Remember, look what's going on. Don't just look at what has happened. Look at what was in place before it happened. Like right here. There's the run down into the order block. Rallies through. And here's we have equal highs. And we have the liquidity void right in here. So we can now outline that as your void. So we'll look to see all of this sell side imbalance, buy side inefficiency. That's what this is here. And this shouldn't be drawn there, it should be here. Okay, so price has only gone down one single candle. And ever since that candle, there has not been any upward movement, or green candle, if you will, to fill in and cover this up, or rebalance it is how we refer to it. So the IPTA algorithm offered sell side heavily here. And that's going to leave porous price action in here where there's gaps. You do not see them, but they exist. Very, very micro porous price action. In other words, there may not have been a fill on anyone trading at 131.73 or 131.70. It may have gapped down lower, 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 and you just didn't see any of that. So what the algorithm tries to do is it goes back up, fills in that to rebalance, and then whatever displacement happens after that is under the higher time frame context, or as we're looking for right now, continuation on the holding pattern because of the Parliament vote tomorrow. Price comes back up. Beautiful filling in here. Look at the, not the wicks, look at the bodies of the candles. If you look at the point at which where the market takes off and goes lower, and I'll point out exactly what I'm referring to in a second. This low, this candle's low, once price goes through that low, it's in a sell side delivery. Price is going to want to go back up to that and offer all those same prices, but while price is going up. So it's a sell side imbalance, buy side inefficiency. If it's inefficient on the buy side, that means they're going to send price back up. Just think of it like this. When you were a child and you were coloring with your coloring book, you had your color and you're coloring all over the page. You can't color that entire image with one stroke down with your crayon. You had to go back up and go back down and keep doing it because you would still see that white of the paper, right? That's all price action does. That's all that it's doing all the time on every time frame. That's all that it does. In the effort of doing that, it will also engineer or remove liquidity. That's also a function of the algorithm. And all of those things coalesce into a very clear depiction of what price action does. And if you understand what you're looking for that particular time frame, in that particular environment, it helps frame out trades. So in here, you could have taken, and this is hypothetical, but this is how you do it, folks. Not all of you can sit and watch live price action. So what do you do when you come home? This is exactly what you do. You find levels that were clear and logical, and you'll build a lot of confidence and you'll build a lot of experience. And also your study journal will have a plethora of examples to look at on the weekends. So price trades up into it here, and also opens and trades to it here, and then goes lower. Now, if you don't want to use the void, you can use the bearish order block. That's this last up close candle here. The low is 31.76.7. Okay, so I round that to the 5 level, 31.75, but we'll see what gets the actual high. Well, 31.76.4. What was that low again? Yeah, so we were just three pipettes away from touching the low of that candle. But rounding it to 75, and this is why we calibrate our levels. We don't just go in here and say, well, whatever that wick is or whatever that open is, I'm going to use that. No, we have to calibrate that. That's how I offset the random distribution of price across all brokers. And it's a 5 pip variance, and that's why I use a 5 or 0 level. So if we're below price, like we would be here coming up to it, this order block, you want to get the closest 0 or 5 level to whatever that low is, or whatever the open is. On the up close candle, and open comes in at 31.78, so it's still 75. So you could be buying down here for a turtle soup, because you're going to see some stops here. Practice buying that. It takes a lot of patience and skill to do it, but most people want to see the break in market structure, and then they trust the order block. Me personally, I don't have any problem with buying below an old low if I have the context of what we're framing here. But it takes time and practice to get into that. I understand. Initially, I didn't like that. I liked these little internal range liquidity runs where you get to the break, you get to a bullish order block. It's clear to see that you trust as support, buy it, and there's your run up to fill the void, and ultimately up to try to get to that bearish order block. Look at the response there. And then some of you would say, okay, well, we're in a bearish market environment for today. This could be a sell short, and I look to see a run below this low. But if that's the low at 31.37, and we're up here, what's the level we're looking for? 31.40. 31.40, because it's the clearest, easiest level on a 0 or a 5 basis. In other words, 31.40 or 31.45 could be one, or if you really want to be gung-ho about it, you can look for 131.35. And I think if you don't, might get it here. No, you don't even get it there. 31.36. So it never even got down to it. The low, one more time to double check that. Yeah, 31.36. It never got to 35. So that's the reason why we like to use the low-hanging fruit theory with targets. Your analysis can call for the absolute high, but as you've seen on my Twitter account and in the mentorship, I give my analyst the stroke of his ego by letting him call the absolute high and low to the pip, but I'm not doing it as the trader. I have to do what makes sense to me, and I want to be getting out in the move. And it may go a couple more pips beyond me, and usually I'm comfortable with 15 to 20 pips early. That might not suit you. You might think, oh, well, I'm going to do better than that. And I've always said my exit strategy is the weakest point of my trading, because you're never right. I'm never going to be right. You're never going to be right. But you may beef up the exit strategies that I teach you and may come up with something entirely superior to what I do. And it won't change my opinion of what I do, because it works. So knowing your weaknesses, I just want to double check this wick here. The low is 131.37.3. So we did get it below it, I think by 1 pip, almost a full pip. Yeah, so it did run to it, but then came right back up, filled in this void. same exercise off that breaker, and rallies up. Now, these aren't huge moves, but when you look at it from the context of all you're doing is studying how liquidity is taken, absorbed, and run to the opposite side of the spectrum. What spectrum is that? The PD array matrix that you'll learn about in month 5. But if we drop down into a 1 minute chart, in that same area of price action, here's that, well, you can see here's a gap that exists there, all the way up to this price point there. So this is where the void begins, all sell side imbalance. So we had a gap in here, a gap in here, a gap here, and none of this price action in here really had any kind of gaps at all, except for, well, that was already filled in. So we have the mean threshold of this up close candle, which is bearish order block. That would be right there, and essentially that's what you get as a high almost. So again, using the low-hanging fruit theory for exiting, it works. I can't stress it enough. There'll be times when it'll move beyond what you looked at exit on your drills and your exercises, but for your trading, just trust me, it works better than any other thing out there. At least it's proven itself to me. We have a 1 minute breaker, bullish breaker. We have the low, ran with this run here. Price runs through it. Last up close candle, that's where you want to be a buyer. Here it is, 1 minute chart. What are you targeting? Liquidity above this high. So exercise from here to here. Again, it's not a ton of pips, but it's 20, 25. And how many times did you see it here? You had one here. You had a short here if you wanted that one. And you have a buy again here. And it's all trading inside of a narrow range consolidation. The fractal is consolidation day. So if you're looking at that, the context is you want to have a higher time frame price level. Well, I've already showed you how to do that. We looked at the hourly chart, and the 15-minute time frame, and framed out a 15-minute breaker. Now, obviously, 15 minutes is not a higher time frame in the sense that it's like a daily or so, but it is higher time frame relative to a 1 minute chart. Everything is subordinate. From the higher time frame down, the lower will be subordinate to the higher time frame. So if we're looking at a 1 minute chart, looking for runs on liquidity, looking for structure, looking for inefficiencies, gaps, all of that, you can clearly study it this way. Now, I'm not trying to entice you to use a 1 minute chart. The 1 minute chart will help see these inefficiencies better than you would if you were just looking at a 15-minute time frame. But anytime we see one single candle or a series of candles like this is all sell side imbalance, buy side inefficiency. The quickest portion of the move where you'll see the most dynamic price action is when it goes up into these levels to fill them. Once it fills it, then it gets, it's trying, and then it gives up the ghost. Prior to that, running into the gaps, that's your biggest injection of volatility. And so you can anticipate, your skill set will improve on when to anticipate big moves or sudden quick moves. Okay, so that's going to be it. I can go on and on, obviously, but this is one way you can take the insights from price action that you didn't really engage in and take details from it and study and build your library of example of example of example. And then you'll get it. Trust me. You have to practice it, though. Until I talk to you next time, wish good luck and good trading.